So that's, now you've got to start looking at other areas of the market and say, okay, even though the overall stock market, let's say tech and financials and things like that, may not be looking all that hot in the charts or from the fundamentals, what's an area that does look good? And energy and metals is something we've been on our radar for a while. And the metals, gold, silver, gold miners, I will tell you right now, are really, really testing my patience here. I mean, they are riding and right on some lines of support that if they don't hold, I'm going to have to change a lot of conversations that I've had the last few months, because I've been moving forward that this chart of gold, this chart of silver, while they've been trading sideways, that this was a consolidation pattern before moving higher. And we haven't totally broken down of support, but man, we are right there. I mean, if there's ever a time that one of our calls could be off, this is it. And so this is one I got to watch really, really closely. The only saving grace in my nerves on betting on silver, gold, and gold miners is that over the last 3 weeks, there's been so much strength in the U.S. dollar. I mean, the dollar has rallied incredible amounts. I mean, today it was up 0.5%. And in that environment, gold, silver, and gold miners have not broken support. They haven't been taken out to the woodshed from the dollar's rally. And the dollar's rally is probably coming close to an end. It's gotten parabolic. So I'm really keeping my fingers crossed here that gold and silver and the gold miners grab some footing and start to move higher, because it's in the portfolio. It's a belief that we've had, I like buying things that support.
I'm a believer in closing gaps, and today we closed a very important gap on gold. So I think that's why we stretched down so much today. There's another gap lower. We could drop down to 170 on gold to close one more gap.
Yeah.
Not every
it's
gap
funny you say that.
I close. But I'm a strong believer that, we got to close the gaps. It could take a day. It could take 6 years. Who knows? But I think that that's the reason more so of the pullback than anything. We got to go back and reset, and then we'll be that stretch higher.
Yeah, I put it right up here on the screen, is that you're talking that gap right there. It's funny you bring that up. I was looking at a daily chart of gold the last year, and I was like, oh shit, there's another gap below. It could go one more step before, probably wash out and get everybody negative and then rip higher. Because this is kind of another form of an expanded flat, just in a different tilt. So if it does get footing and rip higher, it's going to catch a lot of people by surprise and probably, get a little bit of a short sgueze.
Yeah, I mean, when we talked about it before,
I just wish it would start moving now. Damn it.
Well, that goes on a lot of things, but we were talking the other day, that I still think gold rips. I'm in the same camp as you, but I'm worried that it's not going to maybe rip because, with interest rates being high, baby boomers want yield. The people that have been in gold have made nothing for the last, 5 years, 6 years, 10 years. So they're going to maybe push more towards bonds, which we'll get into in a little bit and how that could maybe hurt you. But they want to lock in, get that yield, and you're not going to get that maybe yield from gold. It might just trade sideways. So it has that risk of baby boomers not wanting to just sit in gold forever.
Yeah, it's like all assets probably where, without momentum, nobody's really paying attention to it, except for the experts or the professionals.
Right.
Sorry, go ahead, Pat, or Colby.
No, go ahead, Justin. Go right ahead.
I was just going to say my only counter argument to that would be though I do agree, however, a lot of these baby boomers feel that gold is a safe place. So yes, I think a version of them or a portion of them are very concerned about the overall yield of their portfolio and the income that's coming in. However, they still have this old school mentality of gold is safety. gold is better than the dollar.
True.
You know, it's more safer than
Mhm.
being in UUP or other assets, and they'll feel more comfortable because, you know, in their minds, they're always expecting that the Jim Rickers thing, the end of the world, and we're all going to need, you know, gold bars,
Mhm.
bullets, and butterfingers. So,
Sure.
you know,
Exactly.
that would just
Yeah.
be my only counter argument to it. Not so much that they don't want the yield, but more that they're kind of an old school mindset of, you know, gold is safety to them.
Well,
Yeah.
they
You
got
can see it in
Bitcoin.
the marketing. Well, that's a good point, Patrick. You can see it in the marketing of gold, right? Yeah, you can see that um, if you want to sell gold and you want to target market, you target people over 60. You target the baby boomers. Um, there's nobody targeted in marketing gold advertisements to like 20 and 30-year-olds. Now, crypto, they are, right? You know, and everybody thinks that crypto is going to be, you know, the millennials gold. Yet to be seen. And so, yeah, you're right, Justin. The baby boomers still have an affiliation. I mean, look how many questions we get on a monthly basis. The two top questions are, what do you think is going to happen in the stock market? And should I buy gold? Because I keep getting emails about it. So yeah, they're definitely, but nobody buys any, like you'll know when gold is towards the end of the move when everybody else is talking. Like every baby boomer is going to want, if gold starts to get above $2,000 an ounce and it gets 2,200, 2,400, 2,500, the moment that the news starts talking about it being at all-time highs, everybody's going to want to buy it, right? And a perfect example of that is oil, right? So oil looks incredibly hot. Like we've been big on oil for a while, and we've been buying, exchange traded funds in that oil sector anytime we were around 60, 65 bucks a barrel. And for the first half of this year, it didn't do us any good whatsoever. All right. But however, in the last 2 months, boom, now gold's, approaching 90. Today it was up 3%, I think.
Yeah.
So, I'm sorry, oil. I'm sorry. Oil was up 3% today. So all of a sudden, oil has broken out. And I'm hoping gold and silver break out of their patterns because they're very similar. But oil has broken out of this pattern. And just for geopolitical reasons, all kinds of stuff going into an election year. We've been talking since January that we thought oil markets and oil prices were going to be sticky higher, and probably go to levels that people aren't talking about right now. Not all at once, right? So we've been owners of oil ETFs, and I'm trimming them. We've got profits, so I'm going to tell everybody while we're oil bulls over the long haul, in the short term, we're trimming. Like I would not be chasing and buying oil after it ran up 3% today and it's been up predominantly for 3 months. So buy on the next dip. Like so in our portfolios, we're looking to start to trim these oil and gas positions with the intention to buy them back in the next consolidation phase. So this, I think, is one of the hotter areas to continue to watch going into 2024, especially before the election and everything. You guys got any contrary views or got any
Not
anything you guys
contrary,
want to
but
add
it's
to that?
constantly changing, and we have to keep on it because there's two
So true.
refineries coming on that are going to increase production by $1 million a barrel. So that's obviously going to have an impact. Saudi and Russia just cut production by what?
Yeah.
$1 billion a barrel or $1 million? I don't remember the number.
Yeah.
That's going to have an effect. So it's that, like you always say, it doesn't go up in a straight line. And it's why, we could go up to the $100 a barrel, 150 like they're talking, but it's probably not going to just keep going. We're going to have resets, and that type of stuff.
Yeah.
But I think over the next year, 2 years, 3 years, we do see that, which is not good for our economy. It's going to have even a more detrimental effect on our bear market.
Yeah, so 4 million barrels from that article we shared with each other this morning. OPEC and Russia are cutting by 4 million barrels.
4 million? Okay. So yeah, the million that the two refineries are going to bring are going to do nothing. And those aren't even U.S. refineries. They're international refineries. So.
Yeah, I'm afraid to ask people to drive anywhere in the future because, the implications of this are pretty significant. We already got gas prices here in California at what, $6.50 a gallon.
Yep.
So,
and that's not even winter.
Yeah, well, and don't be shocked if gas prices are, you know, $7-8 a barrel when you get into the first or second quarter of next year. That politically going into an election year, that they'll want to release money from or oil from the strategic oil reserve. You know, there'll be all of these kinds of gimmicks, but you know, the Saudis want this higher. There's a lot of reasons. If you want to know all the fundamental and technical reasons why we believe oil is in a longer term bull market, then call us, because it's a laundry list. We put out a piece in February of our Catch the Next Wave that you can get off our website and our blog that, you know, covers the thesis that we have there. So this is one of those ones that we hope we're wrong, but it doesn't look like it. And by being right, life is expensive, because then you also have food commodities. Like, this is a ETF that tracks both oil, gold, and food commodities. And this is now broken out to the upside. So we're all going to be spending more money at the gas pump. We're all going to be spending a lot more money at the grocery store if we're not already. I mean, I went in there and just bought some chicken and a couple things. It was like $35. I was like, are you kidding me? I mean, that I just bought for myself, you know, and I eat like a bird. So it's like, whew, man, oh man, oh man. So, you know, the implications of energy on our inflation, and then also how it factors into interest rates, because you have a situation where a lot of the inflation numbers that the government is going to use to track and raise rates or not is affected by energy prices. So, you know, I keep just telling all our clients that the only thing I can do for you is make money in your portfolio so it offsets what you're spending at the gas pump, right? And at the grocery store. So, you know, I can't help you save money, but I can at least make it back in your portfolio. And I think that's how people need to look at this.